The economy is not all good. There's persistently high inflation. Supply shortages are still hanging around. Yet, on the other hand, we have these really strong jobs numbers. So are we in a recession or not? We have somewhat of a debate about that here next, my guest and I. Really, an inflation is not officially determined until the National Bureau of Economic Research makes their decision and weighs in. And what does all this mean for real estate? There is an ominous new tax law that can very much hurt you. We're going to hear about that with Wealthability founder Tom Wheelwright and I straight ahead. This week's guest is the founder of Wealthability. He helps you permanently and legally reduce your taxes. He's got a great new book. And, I don't recommend that many books because it takes quite a bit of your time. But his is a book I recommend. It just came out last month. It's called The Win-Win Wealth Strategy. Welcome back to Get Rich Education, Tom Wheelwright.
Thanks, Keith. Always good to be with you.
Tom, economics are always interesting to guys like you and I, but this year has been especially interesting with higher inflation than we've seen in 40 years and the Fed raising rates to counteract that. Tell us your thoughts about the economic forces that are taking place today, Tom.
We're already in recession. So the idea that the Fed is not going to put us in recession, we've been actually in a decreasing increase, if you will, for several years. Jim Rickards, my good friend and New York Times bestselling author, recently wrote a book about that, the new Great Depression. And so we are in recession. I think we technically actually have the 2 quarters. So we are in that place where we're in a recession. People aren't feeling it yet, but people will feel it pretty quickly. We see employment, while the numbers were strong last month, we are seeing some softening of employment. But here's why we're not seeing employment. We're not seeing employment being a problem because of the Great Resignation. Employment numbers don't include people who don't consider themselves part of the workforce. And if you have millions of people who pulled themselves out of the workforce, you're going to have full employment of those who want to work, right? So that doesn't mean that there are more jobs than there were before the recession. It just means there were less people to work those jobs than before the pandemic. Okay. So what we have is we have a really interesting time here because we basically have slow growth and we have high inflation. Normally you think of high inflation going with high growth, but that's not the case. We're in this period of what's really stagflation, which is a term that was coined back in the Jimmy Carter days. Okay, this is the last time we had major inflation. And then what happened was the Fed, but back then, remember, the Fed was able to raise interest rates up to 20%. And the reason it was able to do that is because the debt, federal debt as a percentage of GDP was only 30%. Now it's 130% of GDP. If the Fed raised interest rates to 20%, we would be bankrupt as a country. Okay. They literally cannot do it. The other thing that is going on, which is so interesting to me, people, all they talk about is the Fed and Paul Volcker when they talk about how did we get out of high inflation in the late 70s and early 80s? People forget there were 2 sides of that. There was the Fed and there was Paul Volcker, and he was a very important part of that. But there was also Ronald Reagan. And Ronald Reagan in 1981, 1982, 1984, and 1986 sponsored and got enacted 4 tax cuts. 4 tax cuts in 5 years. And that, so basically, if you think of a race car driver, Keith, a race car driver always has their foot on both the gas and the brake because what they're doing is they're trying to manipulate a finely tuned high-speed machine. So the economy is very much like that race car. And the problem is that we only have our foot on the brake. We don't have our foot on the gas. So we're not able to do anything. If all you do is put your foot on the brake, you're just going to collapse the economy, which is what's going on right now. And then on top of that, we have new taxes coming in. We actually have additional taxes, which are going to put an additional brake on where Reagan was reducing taxes. while Volcker was raising interest rates. Biden is raising taxes.
Yeah, well, you bring up an important point, because when most people think about putting the brakes on inflation 40 years ago, they credit Paul Volcker, but you don't hear very much about those Reagan tax cuts that you just mentioned there. We've had Jim Rickards here on the show. He sent me his book. Talk to us more about why you feel like we are now in a recession. Now, of course, we have had that classic recession signal, which generally means 2 consecutive quarters of contracting GDP. That has happened. But of course, the NBER, the National Bureau of Economic Research, yes, actual human beings sit down and determine whether we are in a recession now or not. And sometimes it takes years for them to do this. So yes, I'm actually talking about human beings sit down and decide this stuff, almost like it's a judge sport like figure skating or something. But tell us more about, amidst these strong job reports, Tom, and we now have more people employed than we've ever had employed in the history of the United States. Tell us more about why you feel like we're in a recession.
2021, 2022, the baby boomers are going, among other people, but the baby boomers especially are going, wait a minute, I'm tired of this. I see it in my own profession, Keith. I'm tired of this. I'm ready to retire. And not only have we seen all those people that would have retired normally in 2020 and 2021 retiring, we're seeing people who would normally retire in 2023, 2024, and 2025 retired because they just said, I'm done. I have a lot of friends that say, well, I always thought I'd work until I was 70.
Yeah.
Right. I mean, that's kind of how baby boomers think.
Right.
And they're going, yeah, I'm not going to. I'm going to retire at 62, or I'm going to retire at 65, or I'm going to retire at 67, whatever it is. But they're not going to wait. They're not going to push off retirement. And then on top of that, you have a lot of people in the Gen Xers that go, yeah, not so sure about this. I'm going to take some time off. And so there are people taking time off, but and then you have 2 earner families, and they go, you know what? We can get by on 1 earner. So they've come out of the market too. So I do think that there's there are fewer workers available to us. And so when we look at the employment numbers, we're really looking at it as a percentage. And when you look at it as a percentage of the total population, unless you saw something different, I have a hard time believing that as a percentage of the total population, we're higher than we've been in the past.
Right. Population growth has been really slow. Yeah, I'm talking about just what I said. The absolute number of people employed today is greater than it's ever been. Interestingly, Tom, to your point, if people can afford to not have to work, and maybe only one person has to work rather than 2, or someone can retire early, well, then how bad is the economy if someone can do that? Now, I'm not saying everything in the economy is good. That's for sure. I think we have more economic ambiguities than we've ever seen in my life. On the other end, we have those awful economic maladies of inflation. Some might even characterize it as runaway inflation. And like you said, I don't know that we have the tool to tamp down on that like we used to. And then another indicator of what I think is a really poor economy is supply shortages, everything from everyday consumer goods to automobiles. How good of an economy is it if you can't even get a hold of what you want to get a hold of? So this is my point about there being economic ambiguities and asking about whether we're in a recession now. It sounds like you believe we are.
Well, I think there's no question we've slowed down.
Yes.
From where we were pre-pandemic.
No doubt.
I don't think there's even nobody's going to question that we've slowed down since from where we were pre-pandemic. And I don't think it's that people have, it's just because people have more money. Of course, they got a lot of money during the pandemic. There was a huge amount of money given away. And to business owners, business owners got, I know business owners got $2-3 million of PPP loans. So there was a lot of money that was just created and given away during that time. So some people have money and they've had money, and I think that's what's allowed people to spend without working. But other people have just said, I'd rather have time than money. So it's not that they are maintaining their lifestyle. They are changing their lifestyle. And I think that's where we see it, because we're going, well, wait a minute. I still see people going out to eat. I still see people traveling on airplanes. I know the Phoenix airport is just packed all the time. How can we possibly be in a recession? Right. Because it doesn't look like we're in a recession. And even the stock market has come back up. Right. It's really not doing horribly. It's just that all of the economic indicators indicate that we're like in a bubble. And at some point, will that bubble just completely pop? Now, I don't know if it'll pop. I'm not 100% sure it's going to pop. What I'm concerned about is it's not that we don't have the tools to put the brakes on this inflation. I don't think the Federal Reserve or the government has the willpower, because here's the thing. We've got a government that is intent on spending us into oblivion. And by the way, this is not just the Democrats. Okay. The Republicans, when they were in power prior to this current administration, they were spending just as much as the Democrats. It's just that now the Democrats have this idea, this modern monetary theory, or what I call magic money theory, which Stephanie Kelton is famous for, and they've adopted it. And the idea is, well, we're just going to pump money into the economy, and we'll put the brakes on with taxes. But if you, for example, and I know we'll talk about the new tax bill that probably is going to pass. They don't have the political will to do it, right? They don't have the political will to really put the brakes on the economy. They don't have, people are complaining about a 5% mortgage rate. I don't know about you, but I remember when I refinanced down to a 5% mortgage rate.
Right.
Okay.
I've done the same thing. Yep. When I bought my first fourplex in 2002, 1 year later, I was refinancing it from about a 6% rate down to a 5% rate. So yeah, it really is remarkable. I mean, just to give some perspective, the Fed has continued to raise a federal funds rate. Well, right now, the Fed funds rate is right back to where it was near the end of 2018. So there's nothing unusually high flying going on with rates, but the rate of that rate increase, of course, has been substantial. Let's talk more about the whole recession impact, Tom. Really, I don't know how much it matters whether the NBER declares this to be a recession or not. I think as far as one understands the anomalies, it kind of depends on who you are with whether it's a recession or not.
But Keith, it is actually important what is said and the categorization. And that is because remember that the economy is based on confidence and confidence alone.
I agree. Okay. Consumer sentiment is low because they think a recession's coming.
So if now if the powers that be say we're in a recession, now all of a sudden consumers go, well, I better stop spending. And so now that just catapults it into a faster recession, right? So I think that's why they're not saying it. I think they're not saying it because this really is a confidence game.
Yeah, it's definitely a more important component with all these ambiguities. What is the psyche of that consumer out there? When we talk about our world, real estate, if this is determined to be a recession, classically, what does that mean? Well, real estate prices usually stay strong in a recession, but this is still important in a sense for real estate investors because typically in a recession, what do we see in the mid phase of a recession or near the end of a recession? What we often see is interest rates going down during those times, if indeed we are in a recession.
I think if you own real estate, what matters is cash flow, and you shouldn't care what happens to prices, except you'd like them to go down because you want to buy at a lower price. So, to me, it's all about how do I get in at a lower price? Well, if real estate does come down in price, which it has come down, it's very much softened over the last 6 months because of the rising interest rates. From everything I've told, now maybe not single family homes, but certainly multifamily has definitely softened, and it definitely is a buyer's market right now. But let's say that we get a huge downturn in the prices of real estate. I'm going like, hallelujah. I'm going to buy more real estate because it's on sale now. I mean, if you look at the people who really made money in real estate, when did they make money in real estate? They made money in real estate in 1990. They made money in 2008, 9, and 10, the last Great Recession. That's when they made all their money. They made it during the crash. You don't make money in real estate when you sell. Everybody knows that. You make money in real estate when you buy. And so what you want to do is, right now, prices are leveling off, at least in the multifamily space. In the commercial space, they've leveled off for a couple of years now. So then the question is, well, gee, if this goes down even more, boy, maybe that's going to be my opportunity to buy more.
Yeah, to the cash flow investor, prices don't matter much. But with what we were talking about before about consumer sentiment and mindset, that certainly affects them with the price. You're listening to Get Rich Education. We're talking with Wealth Ability founder Tom Wheelwright. More important stuff when we come back, including new tax legislation that affects you. I'm your host, Keith Weinhold. There is upward pressure on rents. And you can make this actionable at our sister website, gremarketplace.com. This is where you can leverage my industry context to get started with rental property. I own properties with a lot of these same providers across different U.S. states. Most of these properties, which I've actually never seen in person before. And how can I have the confidence to own rental property without ever having seen it? Well, for one thing, I partner with these turnkey real estate companies, which you can do as well. I'll see you over there at Gre Marketplace. Welcome back to Get Rich Education. You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. We're talking with a frequent guest, Tom Wheelwright. Learn more about him and how he can permanently reduce your taxes at wealthability.com. Tom, you stay up to date on the latest things that Congress is doing and new tax legislation. Tell us more.
Well, so we have, speaking of inflation, we have the Inflation Reduction Act, right?
Yeah.
Which just remember that whatever the government calls it, it's probably the opposite. So let's look at some of the things in this Inflation Reduction Act.
Right.
First of all, we have a new Superfund tax on oil imports. Yeah, that's going to definitely reduce the price of gas at the pump. Okay. Second of all, we have energy credits. And guess what? If you pay, so some of these benefits go to, big producers like solar farms and so forth. If you pay prevailing labor rates, you get 5 times the benefit than if you don't pay labor. That's labor union rates we're talking about. So that's definitely, so basically there's this huge encouragement to pay higher wages and pay union level wages.
Inflationary.
That's not inflationary, right? Then on top of that, now we have a corporate minimum tax. So we have a 15% tax primarily on manufacturers and including pharmaceuticals. Yeah. So that's, what's interesting is at the same time you have this Medicare prescription drug, where they're trying to reduce the Medicare prescription drug. At the same time, they're out there adding additional taxes to pharmaceuticals. I'm going, yeah, that's going to reduce inflation, right? To put additional taxes on pharmaceuticals and manufacturing. Not quite sure how that reduces inflation. And then on top of that, the one thing that may have an impact on inflation is that they're giving the IRS an additional $45 billion for enforcement, which means, by the way, $45 billion for enforcement. Now they're giving them $3 billion for customer service. So that means instead of the IRS answering 10% of their calls, they're now going to answer 20% of their calls. Oh boy, aren't we happy about that? The technology that they put in place in the 1980s, they get a whopping $4 billion for technology, but they get $45 billion for more IRS auditors and more revenue agents and more lawyers. Okay, so let me tell you the effect of that. The Joint Committee on Taxation, they're the actual accountants and lawyers who write the law. Okay, they estimate that the money that the IRS fines with this $45 billion is 78 to 80% is going to come from people who make between $75,000 and $250,000. So this is not coming from the rich folks.
Right.
They are coming and they're knocking on your door. Now you say, well, wait a minute. It doesn't matter because I don't do anything wrong. I follow the law. So a couple of stories here, 2 different deductions that are very clearly in the law. They're absolutely clear that they're in the law. They're incentives that are there on purpose. One's for conservation purposes and one's for business purposes. And the IRS has said, we don't like these deductions. And what they're doing is they wholesale, if you take that deduction, they're going to disallow it. They're not going to look at the reason you took the deduction. They're not going to look at your facts. They're just saying, if you don't like it, take us to court. Guess what, Keith? It costs over $1 million to take an IRS tax case to court.
Wow.
$1 million to take a tax case to court. So you're going, well, wait a minute. The IRS says they come in. Let's say that you took an education credit, right, for sending your kid to college. Okay. The IRS comes in and says, yeah, I don't like the way you reported that. I don't like the way you documented that. I don't like whatever, no matter what. And they say, we're going to disallow that. Okay, so what's your recourse? Well, you can go to appeals, which is just basically doing exactly what that's part of IRS. So that doesn't do any good. Or we can go to tax court, which will cost you hundreds of thousands of dollars. Even before you to get to tax court, it's going to cost you $25,000 to $50,000 in just legal fees, not counting your time and effort. Plus there's interest, plus there's, penalties, plus there's all these other things. So this is basically the Wall Street Journal called it the IRS in beast mode. And that's what it is. This is literally the IRS is coming for you. And I want to be really clear. The IRS is not, the rich people aren't going to pay more tax. They have great accountants, lawyers. They don't lose sleep at night. Okay. That's not what's going to happen. They're going to, the 78 to 80% of the revenue raised under that $45 billion additional tax, according to the Joint Committee on Taxation, for people making $200,000, $250,000 or less. So if that doesn't scare you, I don't know what does.
The Inflation Reduction Act. Is that the name of it?
That's the name of it.
Yeah.
Used to be called the Build Back Better plan. But this is the skinny version. This is the skinny version of Build Back Better. And now they're calling it, because inflation now, of course, is the term of the day. The provisions in it are provisions. They all came out of the Build Back Better plan.
Oh. If
so this is Build Back Better. This is kind of like getting a skinny margarita, right? So it's a skinny Build Back Better plan. But for the Democrats, they feel like, well, we need to show we're doing something about inflation. So we're going to call it the Inflation Reduction Act.
Yeah. Gosh, this sounds so misdirected.
They say it's going to reduce the deficit by $300 billion over 10 years. Okay, so Keith, you know how big that deficit is. And you know that $300 billion over 10 years, that's not very much money, right? That's not very much money in reduction. Here's what it is, though. It's a big giveaway to unions. It's a big giveaway to renewable energy. It's a big hit against manufacturers, and it's a huge hit against small business, because I guarantee you the IRS, what they're after primarily is small business. That is the number one target, is small business. And that includes, by the way, real estate investors. But you think about yourself as investors, but your business, your real estate business. Let's say this, Keith, let's say the IRS comes and said, you took that bonus depreciation in your real estate? Nope. We're just going to disallow it. You have to take us to court to prove that we're wrong. That is what's going on right now. Now add $45 billion, so basically unlimited resources. So people who have never seen an IRS audit are going to see IRS audits. We're going to have way more IRS audits. The money's not going to technology and customer service, which is where it's needed. It's going to accountants and lawyers. Well, they do need some new auditors. There's no question. They just don't. $45 billion is an awful lot of money.
Hey, Get Rich Education Nation. It's Matthew from the editing studio here. Tom's presentation struck such a chord with me. I'm sure you felt the same way. So don't procrastinate smashing the like button into oblivion. I did have one question while watching and editing. I thought some of you might also be wondering the same thing. Is this a proposed bill, or has it already passed? Well, it has actually passed. The reincarnated Build Back Better plan made it through the Senate on a nail-biting tiebreaker vote by the vice president. Wow. Could have gone either way there. Back to the show.
Let's talk about some actionable ways where one can protect themselves more, Tom. I know, in fact, we learned from you last time that we were here, if a taxpayer like me that uses a CPA, typically, that's seen as a CPA is not going to cheat. For example, I use both a CPA, a tax preparer, and accountant, both to have my taxes done. If one prepares their taxes through a CPA, Does that or other things reduce their risk of an audit amidst this new environment?
Well, it does two things. It depends on the CPA, as you know. It depends on the CPA, right? A good CPA should actually reduce your chances of being audited. Absolutely. Because, how you're set up, how you've set yourself up as a business, how you set yourself up as a real estate investor, how it's actually structured, what type of entities you use, et cetera. Some entities get audited more than others. There's no question. Okay. So like a Schedule C or a Schedule E for real estate, those are going to get audited way more often than a 1065, a partnership, or an 1120 an S corporation. So it definitely does help. On top of that, even how you report things on the tax return can make a difference. The second thing, though, which I think is going to be way more important, is when the IRS does come knocking, you going to handle that yourself, really? Are you going to say, well, now I need a CPA? Now you're going to hire a CPA who doesn't know anything about your situation to go in and fight that audit? Are you kidding me? You want to have a relationship. You want somebody, first of all, your CPA better not be afraid of the IRS. If your CPA is afraid of the IRS, which most CPAs are, if your CPA is afraid of the IRS, you need a new CPA. And the way to find that out is you talk, ask them about legitimate deductions like home office that seem to be controversial among CPAs, but they're not controversial at all. That's a legitimate deduction. Could the IRS come in and say, you know what? We don't like home office deductions. Even though it's in the law, we're just not going to allow any of them. That's fine. But guess what? Your chances of being audited are much higher depending on how you report your business. So having that CPA, I think it makes a huge difference, not just in whether you get audited, but what happens if you get audited.
I haven't been audited, but recently the IRS sent a notice that they wanted some more documentation and clarification about some things. They sent that to me. I forwarded that right over to my CPA, and they answered it promptly and confidently because I use a CPA that's from Tom's Wealthability Network. Tom, I know you've been growing your network of competent, trained CPAs. Tell us more about that.
Yeah, so we have about 60 CPA firms across the country that are members of our network. And what we do is when somebody calls us, say a real estate investor, an entrepreneur calls us, what we're going to do is we're going to find the CPA that fits their situation the best. So, I don't need somebody locally. What I need is somebody who understands my situation. So let me give you an example. You want to have somebody, if you're a real estate investor, you want somebody who understands real estate investment. If you're an oil and gas investor, you want somebody who understands oil and gas investing. If you're a small business, you want somebody who charges small business rates. If you're a bigger business, you want somebody who is more sophisticated and can handle, they may charge higher rates, but you're okay because you've got a more sophisticated situation. So we're trying to match you with the right people. And based on your situation, we know our CPAs very, very well, much easier than you trying to go out and interview a CPA. You really want the easy button. Just you call us at Wealthability for sure.
Yeah, I act locally where it makes sense, but I don't buy properties locally. I buy my properties in other states where you have a high ratio of rent income to purchase price and landlord-tenant law that makes sense for property owners. And I also don't have a CPA that's local. Maybe they could end up being local, but instead I don't lead with that. I go get one that understands my situation as an active real estate investor. And Tom, you've been building up your Wealthability CPA network of 60 firms now, like you said. That's really going to help a lot of people, especially with what's coming with this Inflation Reduction Act, and another act like this with such a ridiculously deceiving name like so many of these are. So remind our audience again of how one can learn more about you and get started and really get matched up with that CPA that's right for them.
Yeah. So a couple of things I'd recommend. First is go to wealthability.com and you can schedule a call. It's right there. Schedule a consultation. If, by the way, if you like your CPA, but they just don't know this stuff, send your CPA to us. Have them schedule a call or schedule a call with your CPA and have them, say, look, I'd like my CPA to learn something. I'd also suggest a couple of other things. Both of my books, Tax-Free Wealth, which is a classic, and then the Win-Win Wealth Strategy, 7 investments the government will pay you to make. These are books that you really need some knowledge about tax, because what I always tell my clients is, I can't reduce your taxes, but I can show you how to reduce your taxes. And so you really do need you don't need to know all the details, but you do need a base of understanding. Those two books, I think, are critical to anybody's library if you want to know anything about tax and building wealth, because taxes are your single biggest expense. And there are a lot of tax benefits and there are a lot of investments where the government actually will pay you to make that investment. So that's why I wrote the second book. I want people to understand that the tax law is really, there's some really great wealth building ideas in the tax law itself. And so, I'd send them there. And then, of course, I have my podcast, The Wealthability Show, which we always welcome people to listen to as well.
Well, Tom, it's been valuable and especially informative, as always, with what's happened in Congress. It's been great having you back on the show.
Thanks very much, Keith.